As you may have seen, in the middle of recent COVID waves and lockdowns in the Shanghai area, China reported on the 14th of July a second quarter year-on-year GDP growth rate of 0.4%. This was well below the expectations. Analysts polled by Reuters had expected a growth rate of around 1%, and indeed before this, forecasters thought that a recession in China was unlikely. In June, the OECD, a club of rich countries, predicted 4.3% annual growth for China in 2022 and 4.9% in 2023. But is a recession in the second half of this year a realistic possibility for China? Or will China return to its historically robust growth? Right off the bat, let's look at some key facts about China's economy. China hasn't experienced a recession in the 21st century. This includes during 2008 and 2009, and even in 2020 and 2021, during the height of COVID-related disruptions around the world, when the economy grew by 2.2% and 8.1% respectively. Other large economies experienced significant economic contractions in 2020. In China, average GDP growth since 1989 has been around 9%. Growth since 1989 has been a significant driver of overall global economic growth. Businesses and investors are jittery about the potential for recession in the US in 2023 and in the Eurozone in the second half of this year as interest rates rise and energy prices stay elevated. The three biggest economies in the world are tottering. Because of the interconnectedness of the global economy, the possibility for a recession in one affects the probability of a recession in the other. As Harvard economist Kenneth Rogoff states, China is the shoe that has never dropped in the global economy. All of this means that the lagging Chinese economy, the second largest in the world in nominal terms and the largest in terms of purchasing power, is big news. Let's take a deep dive into a potential Chinese recession. First, let's define what a recession is. The technical definition most economists have been using for decades is 2 consecutive quarters of negative year-on-year real GDP growth. We'll use the same. This means that over a 6-month period, the economy is performing less well than it was in the 6 months of the year prior. So is China headed for recession in the second half of 2022? We'll break this down into 3 components. 1. China's zero-COVID policy and crackdown on big tech. 2. The Chinese property and construction sector. And 3. The global economic slowdown and inflation. Recessions are difficult to predict. This is especially the case when looking at the Chinese economy today, where 2 government policies detrimental to the economy, zero COVID and the crackdown on big tech firms like Alibaba, could be reversed at any time. But if these continue, the chances of recession increase. GDP is the sum of 4 factors: government spending, consumption, investment, and net exports. China's zero-COVID policy is a blunt instrument. When consumers have to stay at home or face significant restrictions on their mobility, they buy fewer goods and services. Fewer train trips, car journeys, haircuts, and chances to eat restaurant meals or buy Louis Vuitton handbags all mean less consumption. Firms will lower their investment in capital when the likely return is lower. Foreign firms have grown nervous about China's zero-COVID policies on the one hand and general geopolitical animosity on the other. Domestic firms in the industrial sector have also likely slowed capital investment. We've all heard of supply chain disruptions. A big contributor to this is the restrictions on Chinese industry under zero COVID. Even so, and perhaps surprisingly, China is exporting roughly as much as it was in the first half of 2021 in yuan terms, and it's importing roughly the same as well. China's relative underperformance last quarter is not necessarily due to downward pressure on its net exports. Since the middle of 2020, The Communist Party has seemed to pursue a deliberate policy of curbing the power of large Chinese tech firms. According to China's statistical authority, the direct value add of information transfer, software, and information technology services accounted for 3.7% of China's GDP in 2020. The large tech firms in this space, however, provide services that are complementary to the rest of China's large digital economy. A crackdown on the Alibabas, Tencents, and Baidus has ramifications on the rest of the economy that are difficult to quantify. And what about government spending? This connects immediately to the ailing Chinese property and construction sectors. John Maynard Keynes is purported to have said on economic growth, "The government should pay people to dig holes in the ground and then fill them up." In an echo of the 5-year plans of socialist yesteryear, the state in China publishes forward-looking growth targets and goes to great lengths to meet them. The official 2022 growth target is 5.5%. To meet that target, the central Chinese government has allowed local authorities to pull forward 1.5 trillion renminbi, or $223 billion, in debt issuance initially scheduled for 2023. The remaining quota for this year, 2.2 trillion renminbi, is to be issued by the end of September. This has long been an issue in China. The funds will be used to build infrastructure and housing, much of which isn't used or has diminishing returns. This type of debt-fueled growth is a metaphorical hole-digging enterprise on a mass scale, but eventually a country runs out of holes to dig, or alternatively, the companies that dig those holes go bust. In December of 2021, Evergrande, China's largest property developer, defaulted on its offshore dollar-denominated debt. In July, the company faced stress in repaying local creditors. Evergrande's difficulties are representative of the entire property and construction sector in China. It's not merely a harbinger of China's looming debt issues. It's a real-time issue, immediately related to a potential recession. In China's Henan province, over 1,000 protesters who wanted to access their frozen deposits were forcibly removed from the doors of the People's Bank of China, a canary in the coal mine for the health of China's banking system. Property construction in China is fueled by debt, and much of this debt is provided by banks. The largest banks in China are state-owned. Construction in China is an enormous industry. If the sector enters stress, so does the financial sector. When banks aren't healthy, credit contracts. And credit, whether in a capitalist economy or China's state capitalist economy, is the lubricant of economic activity. China's proven that its zero-COVID policy, although detrimental to the economy, doesn't immediately translate to recession. The woes of the Chinese property sector is really what has observers concerned. And why? The Chinese property and financial sectors are entangled in a web of opaque connections, and this web is spun by innumerable actors in a blurred hodgepodge of state and business. It already seems like the banks have been impacted by bad loans, but a general lack of information makes it impossible to know how bad the situation might be. We've all seen it in the headlines. High inflation and rising interest rates are not a good combination for the global economic outlook in the second half of 2022 and in 2023. China, largely an exception to the rest of the world, managed to grow during the financial crisis and its aftermath. But could its economy continue to grow if the global economy enters a recession driven by slowdowns in Europe and the US? The real answer to the last half of 2022 and 2023 is nobody knows for sure. America continues to post good jobs numbers. As for Europe, much of the outlook depends on continuing flows of Russian energy, which have already been cut by up to 2/3. Largely independent of all these unknowns is China's emerging debt crisis. The Evergrande default and frozen deposits at the People's Bank of China suggest we should fear the worst, that the Chinese economy sits under a pockmarked ground of holes filled with TNT. When and if they explode is difficult to predict, but the historically weak growth figures of the second quarter are not promising, as they indicate a general malaise in the Chinese economy. What we really need to understand for the outlook of the Chinese economy, not only for this year but for the foreseeable future, is the emerging debt crisis. We'll go more into depth in this in a separate video. As always, thank you for watching. If you enjoyed the video, please like and subscribe.